And welcome to the VSA Capital Tech and Transitional Energy podcast on Thursday, the 28th of July. Now, regular listeners will know that Phil Smith, our analyst, is on holiday this week. They'll also know that although I'm working a little bit, I'm down at my house in Cornwall and on a lot of courses. Well, actually on the same course, but it's the golf course. Therefore, we're not totally up to speed this week on what is going on in the tech and transitional energy sector, although there are a few things that are going on that I've been looking at. But instead, I have decided to invite my head of sales, David Scriven, just to have a bit of a general chat about the market and some of my views of what's going on in the market and with our industry and that sort of thing. So if you're just looking for tech and transitional energy, maybe time to turn off. But if you're interested in what I'm thinking at the moment, and I do a lot of thinking when I'm down here, then carry on listening and we'll just have a chat with David. David, hi.
Good morning to you, sir. It's a pleasure to be with you, and it's going to be very interesting to listen to your current thoughts, because we've just seen the Fed raise rates by 75 beeps. That's the steepest since Volcker in the 80s. Now, both you and I were around then. Now, stocks have rallied off the sort of Powell comment, rates at neutral, but how do you feel things? How do you see things going forward? What do you see the market? How do you feel about the market in general?
Okay, well, look, I think the thing about the market is there are currently three big uncertainties, and markets hate uncertainties. The first, obviously, is the war in Ukraine. We just don't know how long it's going to go on for or what the outcome is. That's uncertainty number one. Uncertainty number two is China, because we are seeing a sort of Cold War II. We're seeing the zero COVID policy. We're seeing a collapse of the property sector over there. And we just don't know quite how China is going to fit into the global marketplace going forward. And we almost certainly won't know until the 20th Chinese Communist Party Congress, which looks like it'll be in November. So that's another uncertainty. And then bringing up the point that you started the question with, the third uncertainty is inflation and interest rates. And we just don't know whether the inflation we're seeing at the moment is transitory and will come back down again. And thus whether interest rates are going to go to the sort of levels that we're seeing at the moment or a little bit higher and stop, or whether they're going to keep going up. And those three uncertainties mean that the market will struggle to go higher. Now, I do think that at the moment, most of that in terms of where we stand as a market valuation is already in the price. So we're sort of on the bottom is my view, but we ain't going up until those uncertainties are out of the way. So there is value in the market, but we may not see it realized for some time. So on the market, that's what my position is really.
I'd just like to sort of throw in, because we've both been in the markets for quite some period of time, with the market fearing recession down the road. What I do note is that unemployment is around about 4%. Now, we've both seen it much higher at sort of 5, 6, 7, 8, or even 11%. And I think, job openings are still very robust. So if there is a recession on the cards, as things stand at the moment, it may not be as severe as perhaps people fear.
Well, as you say, Dave, we've both been around far too long. I came to the market in 1984. I've seen recessions before. The markets continue on a long-term basis going up. Equities are fundamentally a good investment, particularly if you get the right companies. We also, of course, both remember, Dave, interest rates being at sort of 10%, even 15% when we left the ERM. And of course, we probably also both remember having mortgages back in the 90s where we were paying mortgage rates at sort of 12%. And then, of course, we entered into the housing negative equity situation between 92, 93. I remember I took out a bridging loan. I think I was paying something like 16% on my bridging loan. But, of course, I bought a house in Chiswick to do that for £293,000, and it's now worth considerably more than that. So, actually, out of adversity can come opportunity. And a great quote that I tell people is the late Ayrton Senna used to say, you can't really overtake racing cars when it's sunny, but when it's raining, you can overtake 15. And I think that is the sort of period we're in at the moment. There is so much uncertainty, so much going on. Actually, there are a lot of opportunities out there.
Indeed, indeed. Well, when you talk about the housing market, that's sort of dear to my heart at the moment, but I won't go into that in much detail. But with supply shortages, the market is still quite robust, even though we're seeing some signs of weakening both in the US and perhaps here. The other thing I'll just quickly mention, I don't know whether you want to make any specific comment, is we've got a plethora of results coming out. So it's going to be very interesting to see how the market reacts. It's pretty mixed today with some big names, pluses and minuses.
Yeah, look, it's a reporting period, isn't it? And everyone's running around. I think that, the market in general, though, if that's just reporting. I mean, look, the fact of the matter is that we are going into probably recession, so the numbers are going to start to look worse and worse and worse. But the market is almost certainly already taking that into account. I mean, if you look at Rio yesterday, its profits collapsed. They halved their dividend, and actually the stock is now higher than it was 2 days ago. And that tells you that the market already knew that and is now looking forward to the future. Now, on the property prices, I'm obviously very aware that you're buying a new house at the moment, David, but I think that comes down to the fact that people are wondering where to put their money. It's all about asset classes. And there's been a huge move in and out of different asset classes, shall we say. A lot of money actually has come out of equity markets. I mean, the number of stocks quoted on the equity markets is diminishing almost daily, dare I say it. Housing has remained as a very strong asset class because people just feel it's great security, it's safe, there's a limited number that you can buy. And so housing stocks as an asset class has continued to go up. And actually, again, interest rates aren't that severe, probably will continue to hold its value. I don't see a housing collapse actually coming up necessarily. The asset class actually that's had a huge influx of money, and I'm talking trillions and trillions of dollars, of course, is private equity. And private equity now is a bit of a scam. I mean, it's spinning plates because they just, even though some equity values have halved or more, private equity just keep marking up the value of the holdings they've got. And then when they get to the exit point, because there's no market to float it on, they say, I know, let's launch a continuation fund and we'll put in even more investors' money. And, when we put it in the new continuation fund, we'll value it even higher. But there's no regulation on private equity. There's no looking at what the real valuations are. They just keep marking up the value of their assets every year, higher and higher and higher. And yet here's an industry that works on gearing and interest rates are going up. It should actually be going down. Now, I don't think that we can have a collapse of private equity, even though we should, because they just create their own valuation. So how does it collapse? The problem you've got, though, is that, of course, there's no exit route for them other than these continuation funds. And at some stage, asset allocators, who I would say aren't always the smartest people because they tend to follow trends, are going to say no more money into private equity. Let's put it somewhere else. And then private equity's got a real problem. They've got no exit routes for their companies. I guess what they'll do is they'll end up merging all their companies together and just trying to keep the plate spinning. But private equity is a place you do not, in my view, want to go anywhere near at the moment because it is a Ponzi scheme.
But if we steer away on your guidance here on private equity and sort of slightly change the theme and move from markets to exchanges, bearing in mind some of the things you've mentioned as a backdrop of caution, but why do you feel so strongly about Aquis as an exchange?
Look, I think Aquis is a fascinating situation, actually, and I think a lot of people don't really understand or look past it. I mean, I think, again, sitting in the UK, we think the London Stock Exchange is wonderful, because it's our own exchange, it's very strong, everybody talks about it. But the reality is, if you look at an international point of view, the London Stock Exchange consistently loses market share. And actually, its reputation is not that good, particularly with AIM. If you travel around overseas, the reputation of AIM is absolutely appalling. And the number of stocks on AIM has shrunk from like nearly 2,000 to about 800. The number of nomads operating was nearly 100. It's now down below, I believe, 30. I mean, it is not a growth market, the London Stock Exchange. Actually, sadly, it's an ungrowth or a declining market. And yet, as a financial centre, which London is, we're still one of the leading international financial centres of the world. It's incredible. The UK would not be what it is without London and the financial centre. We need a brilliant exchange. And what drives a brilliant exchange is competition. And the London Stock Exchange, unfortunately, has had no competition for 400 or 500 years. It needs it, particularly in this post-Brexit Britain. And if you look at it, other major financial countries have competition. America being the classic, has the New York Stock Exchange and NASDAQ. So we need the NASDAQ of London. And Aquis is the NASDAQ of London, because what they've done is they've brought in, first of all, institutional shareholders into Aquis PLC. So the institutions actually want to back it. They brought in modern thinking and modern technology to make it an easier and smoother market. They've adapted the rules to the internet world. I mean, the London Stock Exchange is just not adapted to the internet world. The cost of floating now is just absurd. You're no change from £1 million for a small company to float on the market, and it'll take them 6 months. That is ludicrous. We have to get away from this, simplify things in the modern era. I'm not saying you should reduce the regulation at all, but you've just got to make it simpler, because if it's simpler, lawyers spend less time and therefore your bills come down. And I mean, at the moment, you're seeing lawyers make absolute fortunes because everything's so complicated and so much. The lawyers have to spend so much time, and of course the taximeter is running. You're seeing accountants make fortunes because everything is going on. And yet investment banks, funny enough, and brokers, although we get knocked the whole time, we don't make any money. In fact, the broking world is basically having a race to the bottom. Aquis would be fresh, new thinking, and it's competition. Now, two things probably been holding back Aquis. One is that it's had a history in its past guises of NEX and plus markets and all this sort of thing. But secondly, the retail platforms were not prepared to link it in so that SIPs and ISAs could trade it. Now, Hargreaves Lansdown, who control about 50% of the UK SIPs and ISAs, which is, by the way, wrong in its own right, they have now put Aquis onto their platform so that you can trade. And I think that Aquis is going to become the NASDAQ of London. In fact, eventually, and I know we're an advised Aquis, so I have to be very careful what I say, but eventually it surely has to be acquired by a big group, because it would be just so tempting to park your bus right next door to the London Stock Exchange that, frankly, is going backwards. And in a nutshell, David, there you go.
There we go. And people can find a lot of information on their website, not least for the fact that in their Q2 newsletter, they talked about Hargreaves Lansdown. So that's very positive development. So encouraging trends for them. And talking of trends, and looking at thematics in general, what's your view on the energy future?
Yeah, look, I mean, any newspaper you pick up, you're going to be hearing about it, with gas prices going through the roof, Nord Stream 1 being turned off, Nord Stream 2 certainly not being built. We are going through a transitional energy revolution, which is why, at VSA Capital, we are very focused and have been now for nearly 10 years on transitional energy. My view is we will eventually end up with what's known as SWB, which is solar wind batteries, as our main energy supply. But you can't ignore gas. We are going to have gas for another 50 years. I am a believer that we should be fracking. I think the anti-fracking group are just, frankly, crazy. We know it's safe. We know it will benefit the economy of the UK. It'll benefit the lives of the people who live locally, because they'll get more money. They'll get support with communities and schools and that sort of thing. Of course, the Russians don't want us to frack because they want us to be beholden to their gas, and they've got their way at the moment. So I think the energy future is basically solar, wind and batteries. We do need a lot of work on batteries, and people know that we spend a lot of time on batteries. I'm not going to get into that debate on this particular podcast, but we do also need gas. The UK has plenty of it. Oil is not about to be switched off completely for some time, so we need to think about oil as well. But yes, we are in a transitional energy revolution. And look, the oil revolution was a sort of over 100 years old. If you'd started investing in oil stocks 100 years ago when oil was just being developed, you would be a very rich man. So today, actually, to become a very rich person, or intergenerational richness, shall we say, you want to be investing in the transitional energy revolution.
Are we perhaps getting a little bit caught out by being concerned on short-term factors, e.g., for example, revenue delays for companies? And for example, today, although the stock is up, Ceres announced that due to timings on licensing deals, I get the sense that revenues are going to be lower than expected for the 6 months. So is this clouding this strong outlook for the sector?
I don't know. I mean, look, it's interesting. I mean, Ceres is a great company, and the two sort of flagship stocks we have in hydrogen are Ceres and ITM. And the great thing for them is they've both got good corporate structures and they've both got a lot of cash so they can ride it all out. But, you know, it's the market plays in a classic case where it gets very, very excited about something short term, races stocks up far too high. It then thinks, oh my goodness, it's not happening as quickly as we'd wanted. So the stocks then come flying back down again. They then get sort of lost in for years whilst they just get on with their business. And then the market undervalues them for a while as they start to actually go into serious production and mass take up. I mean, you know, I saw that classically with ARM. I was very lucky in the beginning of the 90s to meet with Sir Robin Saxby. It was just Robin those days, Robin Saxby, now Sir Robin Saxby, and just 12 people. And, you know, it's fascinating, watch the market get hugely overexcited with ARM, put it on a P of 500, and then we had the dot-com crash. And the stock just collapsed down, you know, almost 90% or something, because the market went, oh, no, it's not going to happen. It's not going to happen. Of course, it did happen. In the end, it was, you know, incredibly successful, probably one of the UK's most successful companies. But that's the way the market works. And of course, David, you spent a lot of time, you know, talking mining stocks in your career, and you have exactly the same thing in the mining industry, don't you? With the curve, should we call it?
The Lassonde curve, yeah, absolutely, we do. Yeah, so you have that excitement surrounding the discovery, and sometimes the market will sort of capitalize it as in full production. So yeah, you do indeed.
So it happens. It's amazing, David. It happens time and time again. Markets get very, very excited short term, and then you have to sort of sell out, step back for a while, let it fall back, and then actually, just as you think the market's given up hope completely, that's when you go in and buy it.
Yeah. Sort of fear and greed, so to speak, of the big thematic there. Just another quick thing on on this subject. I noted that Pensana got a green bond certification from Cicero. And we know about green bonds, but is this going to grow even more as sources of finance? Is this what are your thoughts on that?
Yeah, look, I think first of all, you know, we've just had the publication of the UK Critical Metals Report. And I think one of the keys, we've made some comments socially on social media now about our views of the UK Critical Metals Report, which it lacks one big thing actually, and that is who the hell's going to fund it all and how are they going to be incentivized to fund it all, which is the key to the whole thing. Sadly, the government missed that, but that's politicians for you. I think, though, that, you know, the whole secret, if you look at what China did to become so dominant in the critical metals, was they set up all these processing facilities. So all the ore was being shipped to China to be processed. So then they could build the battery factories, and that's how they became dominant. So we need to look at what they've done over the last 30 years and say, OK, we need to a certain extent to do the same sort of thing, which means building process facilities, which luckily, as you say, Pensana are building a rare earths one, Alchemy PLC are building a lithium hydroxide one. So we are starting to do that, and you do need innovative funding because the fund managers, the institutions are going to struggle to fund the startup of some of these processing facilities. They might come in later, but you need government subsidies, you need government support, you need, I think, yes, green bond issues and this sort of thing, because this is actually ESG orientated, because we're trying to change the whole dynamics and go through this transitional energy revolution. So it does need some quite clever, smart thinking and wrapping the whole thing up into the green environment. And of course, it's very difficult when you look at mining operations to go, is that part of the green environment? Well, yes, if the mining operation for a critical metal is lithium, and it's then going on to become your EV, which is what we're all trying to head towards, because that is deemed as green, then actually that becomes green. You've got to look at the whole ecosystem, the whole cycle, the whole chain to understand the picture. And of course, we do at VSA, you know, we look at all the mines. We've been looking at lithium mines now for over 10 years, and all the other critical metals, the processing, the batteries, the manufacturing, right through to the EVs and the e-scooters, where we also act for companies in that space. So I think innovative thinking is required, and I think those sort of things, that's just part of it, David. You need to have other innovative ways of getting these things done.
Certainly, we certainly have the need here because there's zero lithium production capacity in Europe, and I think Europe will have something like 700 gigawatts of gigafactories by 2025. So there's plenty of need for lithium hydroxide, and we don't want to rely on China. Indeed. Now, on that, and the discussions we've had in general, where is your money invested? This is the critical question, isn't it?
Well, yeah, look, I mean, I think that I always say to people that I'm obviously this is my third, VSA Capital is my third investment bank or brokerage business, you know what I mean, after Oriel and Blue Oar. So I'm a sort of entrepreneurial broker, investment banker, but I do run quite a lot of my own money. I own my own pension fund, I own my own personal money. I run my mother's IHT fund. So people do often ask me where my money is, and so I'm happy basically to say as well, I'm not particularly frightened of it. And a lot of the themes are themes that VSA Capital are involved in. And VSA Capital, of course, is one of my largest holdings. I have a pretty big holding in an investment trust in the UK, which you actually know quite well, David, which is the Vietnam Enterprise Investment Trust Limited, known as VAIL. It was set up and founded by Dominic Scriven, who is, of course, your cousin. But I think the Vietnamese economy just looks absolutely spectacular. I think Dominic Scriven is exceptionally talented. I think as an investment trust, you know, it's sort of 2 billion type investment trust. There's plenty of liquidity. It trades at way too big a discount. Vietnam as an economy is probably the fastest growing economy in the world. I think the opportunities there are quite amazing. You just buy it and sit on it for 20 years. So, you know, that is a pretty big holding for me. Another big holding I have actually is a small, and I would say a lot of the other holdings I have are special situations where, you know, my view in this market is you've either got to know everything about something or nothing. Sitting in the middle ground is always a dangerous position to be. So I have a very big position in a company called Tectonic Gold. It's traded on the Aquis Exchange. We are the advisors to it. But I bought in, admittedly, at a pretty good price when everything was sort of looked as though it was going to be horrific. But they're doing a lot of very interesting things in the gold space in Queensland, and also some quite interesting things in Africa in terms of mining. You know, what I like about this company is it's all about making money. There are no egos here. This is a case of where the management team just want to make shareholders money. That's where their money is, and so I'm backing them too. I also have a pretty big position in a company, again, that we floated on Aquis called Silverwood Brands. It's run by a guy called Andrew Gerry, who was the CEO of Lush, still owns about 20% of Lush. He's also the chairman of Hotel Chocolate, which isn't in everybody's good books at the moment, but I think he's a very, very talented guy. And again, I'm backing him really because I think his talents are great. And so it's, you know, I'm backing management. I'm a great believer actually in backing management, I think in general, I would say. I think that's, you know, you never go wrong doing that.
Indeed.
That's 3 of them. It sounds terrible having to sort of think about what I do own, David, isn't it? I'm down here in Cornwall. I'll tell you what, actually, I'll tell you a couple of others that I own that I think are interesting. And I'm a very directional investor, okay? I have my 2 other biggest positions are, I own a position in the Premier Miton Global Infrastructure Fund. It's run by a guy called Jim Wright. I've had money with him now for quite a long time. He sets out to make you 9% per annum out of global infrastructure. He has pretty much every year made me 9% per annum. So I roll up my income into capital. So it's just grown and grown and grown. So I think that's a great, anybody who just wants 9% a year, that's a great stock. And actually the other one that I have quite a big position in, again, the reason it's quite a big position is just because it's grown so dramatically from when I first invested in it, is the Smith & Williamson Artificial Intelligence Fund. It's now renamed the Sanlam Artificial Intelligence Fund. I bought it when it's still at Smith & Williamson, run by a guy called Chris Ford, and it uses artificial intelligence to run the fund. And again, it's been a spectacular success. So those are my 5 top holdings for what it's worth. Take it or leave it. But I am a great believer in directional investing, i.e. what do you think are the growth areas? Put money into it. And I'm also a great believer in special situations. So you eliminate sort of market movements or FTSE movements or macro things by being very specific. I think finally what I would say is I actually have quite a lot of exposure in total into Cornish mining. I do think there's going to be an enormous revival in the Cornish mining industry. It will probably take 10 years. That's not for everybody. But I think the returns that can be made over that 10-year period could be absolutely spectacular.
Thank you for your thoughts on that, and also your compliments towards my cousin. I have great respect for him, and yes, I mean it's GDP. I think it's around about 7%. They've got a trade surplus in Vietnam, and yes, that discount is 16%. But they are buying back stock, so hopefully that will narrow somewhat over time. And then on some of the other holdings, I think Tectonic, they were slightly delayed in just due to weather on getting their drilling underway. So I think we'll see some more drilling. So perhaps some news from them in the future to look forward to. And I think that, you know, I was speaking with Phil last week on the technology podcast, and we've been seeing some encouraging technical trends in some of the tech stocks in the US, namely 50-day moving averages giving you buy signals. And obviously we had a strong day yesterday on the NASDAQ. So hopefully that's going to be a fillip for your AI fund with Sanlam stroke Smith and Williamson. So I think that's very encouraging. And Cornish mining, I think what the great thing here is the thematic, and also it's UK. So I think we've seen a lot of comments in places like Citywire and what have you, of people who are very interested in this area. So we've got that podcast too, which would encourage people to listen into. So perhaps we could explore a little bit further on VSA. How does VSA's standing in the market, how it differentiates itself, and some of the things that we're doing that support that?
Yeah, look, I mean, our industry, should we call it the stockbroking or the boutique investment bank industry, is not actually a great place to be, probably, David, as you know. When we came into the market, there were fixed commissions of 1.65%, and the brokers made an absolute fortune, and commission rates have just come down and down and down. And now, they're 2 basis points only, sort of thing. There is no money to be made in secondary research, in trading commissions. You make all of your money basically in capital raisings and M&A. But even there, it's a highly competitive industry. I mean, as an example, you may have seen this morning that Ints Group, who bought Arden, obviously, 6 months ago or so, or announced it 6 months ago, are raising money at 5p. When they did the deal with Arden, their stock was trading at 60p. So they thought that Arden shareholders thought they got £10 million worth of Ints stock. Actually, they've only got £1 million worth of Ints stock. Arden was one of the great firms. It's just completely destroyed any value that there was. And it is very difficult in our industry to create shareholder value, but that's what I want to do. I mean, there's no point doing this game, in my view. I'm the largest single shareholder in VSA Capital. I want value. So, here we are sitting in an industry that's basically heading towards the bottom. What we have done is said, look, there's no point trying to compete head on with our competitors. You can't win doing that. We would lose. So let's find areas where we don't basically have competition. And so what we have very much done, and by the way, what I'm saying here, I think applies to every company. Don't go head to head with a load of competitors. Find niche areas to grow in. So the sort of things we do, we've talked about transitional energy. We're a leader across the whole value chain there. We've talked about Cornish mining. We're a leader there in Cornish mining. We've talked about Aquis. We're a leader in terms of Aquis. We're probably the #1 advisor on the Aquis exchange. If it ever does become the NASDAQ of London, we're in a fantastic position. We also, and you could argue, is this a pro or a con, but we're probably about the only firm that really understands China, and we have an office obviously in Shanghai. Haven't been able to visit it for quite a few times, and obviously the relationship with China is difficult, but you can't ignore the fact that it is the world's 2nd largest economy. It's very important for things like mining and various other things, and yet we're one of the leaders in doing business with China. And so that's sort of how we approach things. We're always open-minded. We'll always talk with people. I mean, I've talked with so many people about trying to do deals here and there, but it's amazing. All deals in our industry go wrong, either on valuation or ego. You could argue that I have the same problem, but we are a listed company. VSA Capital is listed on Aquis. We have a valuation of about £4 million. Actually, we're trading not far above net asset value. So, I think we're probably correctly valued. We do make money. We've made money for the last 6 years. So again, I would actually say we're in quite a strong position. We also, talking of niches, we have obviously some joint ventures in Africa with FIDA Investments and Moshi Capital, and we're probably fairly unique in what we can do in Africa compared with other brokers as well. So again, I think the point is that we look and try and find areas that other people aren't competing in. And we push the boundaries a bit. We tend to be very early on. We were incredibly early into transition energy and lithium. We were talking about it in 2013 when nobody else was. So we do tend to be early, but I'd rather be early than late.
Indeed. No, I fully support that. And I think it's very important to have sort of global tentacles, as you've just alluded to. And I think another thing is that the way we're set up, because I've worked for bulge bracket firms in the past, and we have a team in place, and we all work as a team and communicate very well together. And I think that's very helpful too, because it means that you can turn around things quickly, you can focus minds and share views, and then buy into the niche or the concept or the theme or the company that you want together. And then that means everybody's on board, rather than sometimes if you work for larger organizations, it's a bit more disparate, and sometimes things come out of the blue rather than a consensus.
That is true. Now, I'll tell you what, David, I think we've been chatting for about half an hour. I think that's probably quite long enough. What I would say is to anybody listening to this, if they want to know anything more about some of my thoughts or VSA thoughts, or more about VSA, etc., 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 then just direct message me, give me a call, send me an email. Always happy to talk to people. David, thanks for coming in and sitting in Phil's place. I hope that people enjoyed the slight change of subject. I think Phil is back next week, so we'll be back to normal.
Pleasure, thanks.